What if I told you that silver just shattered all-time records, breaking through $95 per ounce while the London Bullion Market Association is quietly facing a potential collapse? What if I told you that China just weaponized the global silver supply, cutting off 60 to 70% of exports starting January 1st, and that physical silver is now trading at $80 per ounce in Shanghai while paper contracts sit at $35? The silver market is imploding in real time, and what I'm about to reveal could change everything you thought you knew about precious metals. Welcome back to the channel. If you're new here, this is where we break down the real story behind silver, gold, and the precious metals markets that mainstream media refuses to tell you about. Today, we're diving into the most explosive silver developments of January 2026. And I'm warning you right now, what you're about to hear is not just shocking, it's unprecedented. Before we get started, smash that like button right now. Drop a comment below telling me how many ounces of silver you're stacking, and subscribe for more silver content. Let's start with the elephant in the room. Silver just did something it has never done before in recorded history. As of January 20th, 2026, silver is trading at $95.32 per ounce. That's a $64 increase compared to 1 year ago. We're talking about a 208% gain in just 12 months. To put this in perspective, silver gained over 142% in 2025 alone, making it the best performing precious metal of the year, crushing even gold's 66% return. What if I told you that silver just shattered all-time records, breaking through $95 per ounce, while the London Bullion Market Association is quietly facing a potential collapse? What if I told you that China just weaponized the global silver supply, cutting off 60 to 70% of exports starting January 1st, and that physical silver is now trading at $80 per ounce in Shanghai while paper contracts sit at $35? The silver market is imploding in real time, and what I'm about to reveal could change everything you thought you knew about precious metals. But here's where it gets absolutely insane. On January 21st, silver broke through $90 for the first time ever, hitting $92.39 before consolidating around $94 to $95. The London Silver Auction, which has been running since 1897, recorded trades above $90 for the first time in its 127-year history. Now, mainstream analysts are scrambling to explain this away as just another bull market rally. But what they're not telling you is what's actually happening behind the scenes. This isn't speculation. This isn't retail FOMO. This is a structural collapse of the paper-silver system, and institutions are racing to get their hands on physical metal before the entire fraud is exposed. Citigroup is now forecasting silver will hit $100 by March 2026. Bank of America analysts are calling for continued upward momentum throughout the year, but even these conservative Wall Street estimates are missing the bigger picture. Let me show you what's really happening. On January 1st, 2026, China dropped a nuclear bomb on the global silver market, and most people have no idea what just happened. China implemented new export restrictions that fundamentally changed the game. Starting January 1st, any company wanting to export silver from China must obtain a special government license from the Ministry of Commerce. And here's the kicker: these aren't easy licenses to get. To qualify, companies must demonstrate they executed silver exports annually from 2022 to 2024. New applicants must prove annual production exceeding 80 metric tons and consistent export records. They also need credit lines around $30 million just to be considered. What does this mean in practice? It means that small and mid-sized exporters have been completely eliminated from international markets. Only 44 companies received approval to export silver under the new framework for 2026 and 2027. 44 out of hundreds that previously operated. And here's why this is absolutely devastating. China controls approximately 60 to 70% of the global silver supply. Not just mining, but refining infrastructure. They are the dominant gatekeeper to newly mined silver worldwide. When China restricts exports from 60 to 70% of global supply, international availability doesn't just drop, it collapses overnight. Even Elon Musk recognized the gravity of this situation. On December 28, 2025, Musk responded to a post about China's upcoming export rules on X, stating, quote, "This is not good. Silver is needed in many industrial processes." And he's absolutely right. Silver plays a critical role in electronics, medicine, renewable energy, electric vehicles, semiconductors, and advanced technologies. China just weaponized this dependency, particularly targeting sectors central to the global energy transition and technological innovation. This isn't about environmental protection like China claims. This is economic warfare. This is China taking a page out of their rare earth metals playbook and applying it to silver. They did this with rare earth starting in 2010. And look what happened. Rare earth prices exploded by 400 to 600% within months, and Western industries were held hostage. The licensing framework allows for graduated escalation, from reduced quotas to complete prohibitions, depending on geopolitical circumstances. China can turn the spigot on or off whenever they want, and there's nothing the West can do about it. The economic fallout is already evident. Physical silver in Shanghai is now trading at premiums exceeding $80 per ounce, while COMEX futures contracts, which are paper promises, are sitting at $35. That's a $45 spread. The bifurcation of the global silver market is happening right before our eyes. Now let's talk about something that should terrify everyone holding paper silver certificates. The London Bullion Market Association is facing an existential crisis. The LBMA is the heart of global spot silver trading. It's supposed to be the most liquid, most trusted precious metals market in the world. But in January 2026, cracks in the foundation became impossible to hide. Here are the facts. Between early and mid-January, in just 7 days, 33.45 million ounces of silver were physically withdrawn for delivery from COMEX. That's roughly 26% of COMEX's registered inventory disappearing in a single week. Let me say that again. 26% of available silver vanished in 7 days. But the LBMA situation is even worse. According to TD Securities analyst Daniel Gali, the LBMA has approximately 155 million ounces of freely available silver, what they call the free float. That sounds like a lot until you realize that annual global silver demand runs at roughly 1.2 billion ounces. Do the math. 155 million divided by 1.2 billion. The LBMA's free float covers approximately 6 weeks of global demand. 6 weeks? And here's the terrifying part. Silver lease rates, which measure how expensive it is to borrow silver, exploded from around 0.3 to 0.5% in normal markets to 8% in January 2026. Why would lease rates spike like that? Because institutions and central banks are desperate to borrow physical silver to cover their short positions and delivery obligations. When lease rates go parabolic, it means one thing: there's not enough metal to go around. Even more concerning, there are persistent rumors that the LBMA overstated its silver holdings by 3,300 metric tons back in 2021. Although they claimed it was a calculation error, it left deep scars on market confidence. When you're dealing with an organization that accidentally miscounted by 3,300 tons, how can anyone trust their current inventory figures? By October 2025, the LBMA claimed they added 54 million ounces in a single month, the largest monthly increase in at least 9 years. But industry insiders are incredibly skeptical. How do you magically find 54 million ounces during a historic silver shortage? The timing is suspicious at best, fraudulent at worst. Here's what's really happening. The LBMA operates on a fractional reserve system, just like banks do with dollars. They've issued far more paper claims on silver than they have physical metal in their vaults. For decades, this worked because nobody asked for delivery all at once. In 2026, that assumption failed. King Kong 9888, an analyst based in Hong Kong, recently revealed that people asking for physical delivery from the Shanghai exchange are only receiving about 1 to 1.5% of what they're requesting, with the ability to defer delivery for 60 days. This isn't a default yet, but it's a warning sign. When exchanges start deferring deliveries, it means they don't have the metal available today. They're hoping they can source it or convince people to take cash settlement instead. And here's the critical point. Unlike an investor who might accept cash settlement, industrial manufacturers cannot run their production lines without physical silver. Solar panel factories, electronics manufacturers, electric vehicle producers, they need the actual metal. They can't use a paper promise. When these companies turn from the futures markets and demand physical delivery, they become what analysts call forced buyers, willing to pay almost any price to secure supply. And that's when the paper silver system breaks. Let me paint you a picture of just how bad the supply situation really is. The silver market has been in a structural deficit for 5 consecutive years. That means global demand has exceeded total supply, including both mine production and recycling, for 5 straight years. In 2025, global silver demand reached approximately 1.24 billion ounces. Total supply, including mine production and recycling, came in at roughly 1.01 billion ounces. That's a deficit of somewhere between 100 million and 250 million ounces, depending on whose numbers you trust. But here's what makes this deficit catastrophic. You can't just spin up new silver mines overnight. Most silver, about 75%, comes as a byproduct of copper, zinc, and lead mining. These mines aren't optimized for silver production. They're digging for copper, and silver just happens to come along for the ride. When silver was sitting at $20 to $25 per ounce, it probably wasn't cost effective for these mines to process the silver byproduct. But now that silver's at $95, you can bet they're starting to cool that material sitting in piles. However, even if every copper, zinc, and lead mine in the world starts processing their silver byproduct tomorrow, it's not enough to fill the deficit. And dedicated silver mines, those take over a decade to develop and become operational. You need geological surveys, environmental permits, infrastructure development, financing, construction. By the time a new silver mine comes online, we could be in 2037 or 2038. Meanwhile, ore quality at existing operations has been declining. Miners are digging deeper and processing lower grade material, which means it takes more energy and more cost to extract the same amount of silver. Recycling can't bridge the gap either. Sure, some silver gets recycled from electronics and industrial applications, but it's nowhere near enough to offset the deficit. Here's the math that should terrify paper silver holders. COMEX registered inventories have plunged 70% since 2020. London Bullion Market Association vaults have lost around 40% of their holdings. Shanghai inventories have fallen to their lowest level in a decade. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. Exchange balances of silver on COMEX dropped from 130 million ounces down to approximately 60 million ounces. That's over a 50% decline in available silver sitting on exchanges ready to be delivered. And remember, this is happening before China's export restrictions fully impact the market. We're only 3 weeks into the new regime. The full effects won't be felt for months as existing supply chains run dry. In January 2026, that assumption is being tested to its absolute limits. Think about it like a bank. Your bank doesn't keep all your deposit money sitting in the vault. They lend it out, invest it, use it for other purposes. They operate on fractional reserves, keeping maybe 10% of deposits on hand and assuming that not everyone will withdraw their money at the same time. What happens when everyone shows up demanding their money? Bank run. The bank collapses. The same principle applies to silver markets. The LBMA, COMEX, and other exchanges have been operating as fractional reserve warehouses. They've issued way more warehouse receipts and futures contracts than they have physical metal in their vaults. For decades, this worked fine because most contracts settled in cash. Speculators didn't want the physical metal, they just wanted to trade price movements. Maybe 5 to 10% of contracts resulted in physical delivery requests. But in 2026, something changed. Industrial manufacturers, sovereign nations, and institutional investors started demanding physical delivery at unprecedented rates. Why? Because they've lost faith in the paper promises. Because geopolitical tensions mean swift transfers can be blocked and accounts can be frozen. Because when you hold a warehouse receipt and the warehouse can't deliver, that piece of paper becomes worthless. Russia's frozen gold reserves demonstrated this perfectly. You think you own assets held in foreign vaults until one day the host country decides you don't? Then your billions of dollars in assets vanish overnight. Against that backdrop, who wants to rely on an LBMA warehouse receipt? Who wants to hold a COMEX futures contract when delivery delays are stretching to 4 to 8 weeks? The answer, physical metal in your possession, is the only thing that matters. This is why we're seeing a historic divergence between paper and physical silver prices. Shanghai, physical silver, $80. COMEX futures, $35. That $45 spread represents the market's assessment of counterparty risk and delivery uncertainty. And here's the terrifying implication. If the paper-silver system collapses, if exchanges declare force majeure and settle contracts in cash instead of metal, the price discovery mechanism breaks entirely. The official price on computer screens becomes meaningless because nobody will sell real metal at that fake price. Just like we saw during the mysterious COMEX server outage on Thanksgiving when the market went dark. Physical silver would trade at whatever price buyers are willing to pay, which in a shortage environment is essentially unlimited. Now let's talk about something that could be the final nail in the coffin for paper silver: Basel III. Basel III is a set of international banking regulations designed to improve the stability of the financial system by requiring banks to hold more capital reserves. One of the key provisions affects how banks value their assets, specifically precious metals. Under Basel III, unallocated gold and silver, which are basically paper promises, will no longer count as Tier 1 assets for banks. Only physical allocated metal will qualify as a zero-risk asset on bank balance sheets. What does this mean in practice? It means banks that hold massive short positions in silver futures will need to either deliver physical metal or significantly increase their capital reserves to cover the risk. Many analysts believe Basel III implementation will render most futures contracts worthless or at least significantly diminish their legitimacy as price discovery mechanisms. This is what one of the speakers in that CoinShop conversation was alluding to when he said he's stacking silver and gold for when the COMEX fails, for when the LBMA fails, when force majeure is kicked in and people want their metals and cannot get them. Force majeure is a legal clause that allows a party to break a contract due to extraordinary circumstances beyond their control. If COMEX or LBMA declare force majeure, they can settle silver contracts in cash at whatever price they determine, regardless of the actual market value of physical silver. Imagine you're holding contracts for 1,000 ounces of silver. You're expecting delivery when silver hits $100 per ounce, but COMEX declares force majeure and settles your contracts at $95 in cash. Meanwhile, physical silver is trading at $150 on the street. You just got robbed of $55 per ounce or $55,000 on your 1,000 ounce position. This is why owning physical silver matters. Paper promises can evaporate. Physical metal in your possession cannot. Here's something that makes the silver shortage even more acute. Industrial demand is absolutely exploding, and it's not price sensitive. Silver is essential for solar panels, and the solar industry is booming. Each solar panel contains about 20 grams of silver. With global installations accelerating, particularly in China and India, solar panel manufacturing alone is consuming hundreds of millions of ounces annually. Electric vehicles use significantly more silver than traditional cars, anywhere from 25 to 50 grams per vehicle, depending on the model. As EV adoption accelerates, silver demand from the automotive sector is skyrocketing. Electronics, semiconductors, medical equipment, batteries, all of these industries require silver because of its unique properties. Highest electrical conductivity of any metal, highest thermal conductivity, most reflective, and it's antibacterial. There are no economically viable substitutes for silver in most of these applications. Sure, you can use copper for some electrical applications, but it's less efficient. You can use gold, but it's way more expensive. For most industrial uses, silver is irreplaceable. And here's the key point. Companies like Samsung, Tesla, solar panel manufacturers, they're not buying silver as an investment. They're buying it because their production lines will shut down without it. When Samsung needs silver to manufacture smartphones and they can't get it from traditional suppliers, they become forced buyers in the physical market. They'll pay whatever it takes to secure supply because the alternative is halting production, which costs them millions of dollars per day. This creates relentless, non-negotiable demand that the paper system cannot finesse. Unlike a speculator who might accept cash settlement, a factory cannot run without the physical material. And unlike financial investors who might sell when prices spike, industrial users have to keep buying regardless of price. They don't have a choice. This is what makes the current silver shortage so different from past price spikes. In 1980, the Hunt brothers tried to corner the silver market through speculation. It was an artificial squeeze that collapsed when regulators changed the rules. In 2026, we're dealing with real structural scarcity driven by legitimate industrial demand colliding with supply constraints and geopolitical export restrictions. This doesn't end with rule changes. This ends when supply increases or demand decreases, and neither of those is happening anytime soon. Let's talk about where analysts think silver is headed, because some of these predictions will blow your mind. The conservative case, $120 to $180. Many analysts, including the speaker in the CoinShop conversation, believe silver can reach $120 to $180 by the end of 2026. The base case assumes Basel III creates additional pressure on paper silver markets, LBMA and COMEX experience continued delivery stress, and industrial demand remains robust while supply stays constrained. Under these conditions, silver breaking through $100 is almost inevitable, with $120 to $150 being the likely trading range by year-end, and spikes to $180 during periods of acute shortage. The aggressive case, $200. Some analysts are calling for $200 per ounce by the end of 2026. This scenario requires China maintaining strict export controls, major industrial buyers engaging in panic buying to secure multi-year supply, COMEX or LBMA experiencing an actual delivery default or force majeure event, and Basel III enforcement accelerating the collapse of paper silver markets. Alright, we're getting close to the end here. If you've made it this far, you absolutely need to smash that like button one more time, drop a comment with your silver price prediction for 2026, and subscribe for more silver content. Now let's address the elephant in the room. Will silver pull back before it goes higher? The answer is almost certainly yes. Nothing goes up in a straight line forever, and silver's recent climb from $76 to $95 in just 3 weeks is parabolic. The speaker in the CoinShop conversation made an excellent point. He said, quote, "I do think there's going to be a pullback at some point. What we don't know is whether the pullback's going to be at 90, at 100, 110, or 120. When it does pull back, it could be sharp because it's moved up very high, hockey stick, it's gone up. The pace is not good in my opinion. It's too fast, way too fast." He's absolutely right. We just started a gold bull run in 2024, and the silver bull run began in 2025. Historically, you don't see silver prices hockey stick like this so early in a bull market. This kind of price action usually happens 2 or 3 years into a cycle, not at the beginning. So what does this tell us? It tells us that silver is being seen as so strategically important by nations and companies that there are funny games being played behind the scenes. This is a world strategic resource war. It's not kinetic with weapons, but it's economic warfare over who can corner critical materials. When the pullback comes, and it will come, it could be sharp. We might see silver drop 10 to 20% in a matter of days or weeks. That's normal in bull markets, but here's what you need to understand. Pullbacks in a bull market are buying opportunities, not reasons to panic. If silver pulls back from $95 to $75, that's a gift. If it pulls back from $110 to $90, that's a gift. The key is to look for higher highs and higher lows. That's how you confirm the uptrend is intact. Each pullback should find support at a higher level than the previous pullback. Each rally should reach a new high above the previous high. As long as that pattern continues, the bull market is alive and well. Some analysts who were calling for $15 silver 3 months ago look absolutely ridiculous now. $15 silver? You can't even mine it profitably at $15 with current production costs. Most analysts estimate all-in production costs for silver are somewhere between $18 to $25 per ounce, depending on the mine and region. At $15, miners would be operating at a loss. The bottom is in. The structural deficit ensures that. The question is, how high do we go before the next correction, and how severe is that correction? My personal take? We probably see a pullback somewhere between $100 and $120. Maybe we get a 10 to 15% correction down to $85 to $100. Then we consolidate for a few weeks or months before the next leg up toward $150 to $180. But if COMEX or LBMA declare force majeure, all bets are off. We could see silver gap up $30 to $50 overnight as people panic to secure physical metal. Let me give you my honest assessment of what's happening and what you should do about it. First, understand that this is not financial advice. I'm not a licensed financial advisor. You need to do your own research and make your own decisions based on your personal financial situation. That said, here's what I'm seeing and what I'm doing. Own physical silver, watch the indicators. Keep an eye on COMEX registered inventories, LBMA lease rates, Shanghai premiums, and industrial demand metrics. These will give you early warning signals of whether the squeeze is intensifying or easing. If lease rates spike above 10%, that's a red alert signal. If Shanghai premiums widen to $60 or $70 above COMEX, that's another red alert. If COMEX registered inventories drop below 50 million ounces, we're in endgame territory. Prepare for volatility. The next 12 to 24 months are going to be wild. Silver could easily swing 20 to 30% in either direction within weeks. If you panic sell during the dips, you'll lose. If you chase the spikes with FOMO, you'll lose. Have a plan, stick to your plan, and adjust only when fundamentals change. Consider mining stocks carefully. Some people like to speculate in silver mining stocks for additional leverage. When silver prices rise, mining stocks often rise faster because their profit margins expand dramatically. But mining stocks come with company-specific risks, management quality, geopolitical risks if they're mining in unstable regions, operational challenges, dilution through share offerings. If you're going to speculate in miners, do your homework. Look for companies with producing mines, low costs, strong balance sheets, and good management teams. Physical first, everything else second. I can't stress this enough. Your foundation should be physical metal in your possession. Then, if you want to speculate with mining stocks, futures, or options for additional upside, go ahead. But never let derivatives become your primary exposure. When this system breaks, you'll be glad you hold the real metal. All right, let's bring this home with my personal predictions and final thoughts. My silver price prediction for 2026. Conservative case. Silver consolidates between $110 and $140 for most of the year, with occasional spikes to $160 during shortage panics. Base case. Silver trades between $120 and $180, breaking through the $200 level at least once during the year before pulling back.